The following is a presentation of TFNN. Now, TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls now, toll free at 1-877-927-6648. This is the Futures Hour. Here's your host, Larry Pesavento.
Okay, good afternoon, folks. Well, we are in the midst of a big sell-off in gold and silver that we've been expecting, and I posted into the Tiger TV the 60-minute silver chart going back a couple of months, and we talked about, just a few days ago when, the silver broke the 786 level at 31.50. I believe it was trading around 31.28. That it looked like it was going to drop another $10,000, and we've gone down to the 1.27 expansion now at the 29.75 level. Now, what's important about this is that if you'll take a minute and go into Tiger TV, I'm going to put the daily chart of silver into the Tiger TV, so you'll be able to take a look at that, because that's very important also, because we are setting now at a ABCD Gartley pattern coming in at the 29.63 level in silver. We're trading at 29.78 right now. And so this is a Gartley pattern. We have a very strong move down in the CD leg, so it's probably best to wait a day or so to make sure that this bottom holds. But this is a spot where you want to start looking, to be a buyer of both silver and gold. I'll cover the gold when I'm finished with silver. But silver is still in a relatively pronounced downtrend from, 2010 high that we made at 49 and change. Gold is acting a little bit better, but it is still also, under some pressure. But we have some other things happening in gold that, that are important. The main thing that I think we have to realize here at TFNN is when we talk about these levels, when they break through, the 786 level like we did in the silver at 31.50, that just means that the market is being pulled down to the next, set of ratios. And, in this particular case, it would be the 1.27 ratio. And then that also becomes the 61% retracement on the daily going back from last July. So it's fitting, together nicely. So we're in the time zone here to be a buyer of both gold and silver. We've been watching this for quite some time. Last week we talked about the importance of that 1690 level per ounce, that if it broke, that, the gold would be heading towards the, 1630 level. And now we're within just a heartbeat of that particular pattern coming to bear. We are very, very close. I'm going to move over to the gold market now, because this is a very important spot that we are. So far today's low has been 1636, and we believe we're going to get down into this 1630 to 1625 level without too much trouble. But the important part of the gold market that we're looking at here is the fact that if we look at the time period, and if you get a chance to go into Tiger TV and take a look at this, it's really quite informative, and it shows you the symmetry and harmony that's in the market, and it shows that that we're looking at a high that occurred in October, and then we came down into November. It was almost exactly 1 month, and then we made another high on November 26th, and now we're coming down, and we're almost the exact same number of days, coming into this 61% retracement level at $1,630 per ounce. Now, if you're bullish gold, you're still in an uptrend because you have higher bottoms. You're forming an absolute perfect Gartley here at the 1630 to 1625 level per ounce. You have to risk about $20 an ounce there, which is $1,000 a contract, which is quite a large amount. But when you stop and think that the contract is $164,000, it's really not that very much. Now, the second alternative, and this is the one that I would suggest that we look at, this is the one where we would be bottoming either today or tomorrow and then wait for the first rally, and then look for the first pullback after the rally. Let's say, assume we hit around the 1630 level in the gold, and then we rally up to around 1655, and then we back off to a 61% retracement of that, which would be down around the 1640 level. Then that's where you would buy it, and then put your stop below the low, whatever it happens to be on this move down. So we have time and price are squared. In other words, the time down and the time down in both time and the time down in both price are equal. This was the time squaring of price and time that W.D. Gann talked about back in the 30s and 40s. This is a simple way of looking at it, but we also have this Gartley forming at the 16.30 per ounce, and we're still about $10 away from that level, but we're very, very close. We're about 10 cents away on the silver. Now, those of you that want to reduce your risk even more, you could look at a GLD, look at a call, one that's right at the money, because this is either going to work right away or you're going to be out of it in a heartbeat. So look at a in-the-money call with maybe go out to one strike, and then you'll be able to not risk very much if you wanted to look at it that way. So this is what we're looking at with both the gold and silver. They're lined up absolutely perfectly. They cannot be any more perfect than where they are now. Does that mean they're not going to fail? No, that does not mean that. It means they could fail, and if they do, you stand aside. But right now, everything is setting up, for a bounce coming down in gold. And we certainly are oversold. We're down 8 days in the gold market and down 10 days in the silver market. And, of course, silver, is much more volatile than gold. So when it drops a lot faster. And when it goes up a lot faster, because it has 1/6 of the liquidity that gold does. In other words, there's 6 times as many traders, in there trading gold than there are trading silver. So that's one of the reasons why you have that, extreme volatility. So both gold and silver have done exactly what we expected them to do. They're coming right down into this move. Again, the thing to remember is that when we talk about these support resistance areas, that level at the 786 at 1690 in the gold, that once that broke that it acts as a magnet going down to the next level, and that's exactly what happened. It doesn't always work that way, but the probability of it working that way is very, very high. So you need to respect the support and resistance of these places on the charts that we look at. But remember, these are only guidelines. That's all they are. That's all technical analysis is. It's putting probabilities in your favor, and it does put probabilities in your favor. It puts a positive expectation in your favor. These are very positive things for trading when you're using pattern recognition swing methodology. But by any stretch of the imagination, it certainly isn't perfect. So you have to be able to realize that, and this is where you have to take responsibility and put your risk in. And this is what we try to do, is to give you some ideas of where the market, you should be right, and where the market should be wrong. That's what we're trying to do. Now, we need to take a look at the copper market, because we've had a tremendous move in copper over the past few days here, especially today. It's just getting beaten up pretty badly, and for some reason I have lost my copper. I don't know what happened to it, but here it is. I found it. Give me a second here, and I'll put this into Tiger TV. And you'll see we've been talking about that 61% retracement for quite some time, and we did go up, and we made that last week at the 370 per pound level, and now we're trading a good 16 cents per pound level lower in the copper. It's trading down at the 354 per pound level, and you have to ask yourself the question. We had a big run in stocks. And yet copper, being the big industrial metal that it is, that has a correlation with stocks of, well over 75%, it could not go up during that time. And now it's given, over 61% of the last month's action back in just a matter of a few days. So that's telling us that, we have some, things might not be as kosher as they look like in the rest of the market with some of these commodities. And believe me, folks, I could spend 3 hours here today showing you the failures that are happening, because they are happening everywhere. They're happening in corn, and they're happening in wheat and other things too. And this was after they had really good rallies, and so that's another sign, that these things have not bottomed yet, and they've got farther to go, on the downside. After we get, through the break, we certainly want to take a look at the corn market and also the wheat market, because we've been following, them very, very closely. The only market of all the commodities, of the major commodities, that is not really broken down and still looks that wants to go a little bit higher, and that is the crude oil. We're looking for a price level up there around $91 a barrel. We're at 89 and change right now, but I think we could go $1.50 to $2 higher in crude oil to finally make the final exhaustion high up in that market, if we can get there, because it's held up extremely well with the rest of the markets. I mean, it didn't even have downticks when gold was dropping, $30 an ounce, and silver was dropping, $2 an ounce. And these are very, very substantial moves in both gold and silver, because these hedge funds, they're heavily involved in these, and when they get hit pretty bad, because of the fact that these are high net positions. In other words, to hold silver, silver was trading for $30 an ounce, and it's 5,000-ounce contract, so that's a $150,000 contract. Gold is $1,640 an ounce, and it's $100-ounce contract, so that's $164,000. So these are very high margined commodities, and when they break, they have to come up with more money. And usually they have plenty of money backed up, but what they do is they liquidate down so that they don't get hurt too bad on the liquidity part of it. So that's what they're trying to do with hedge funds. What we do in our hedge fund is we try to take a little shorter-term view so that we don't have to risk very much, because there's no reason to risk $20 on gold. Is if you'll be patient and wait for a lower-risk entry, you'll have a better chance of getting a better chance. Now remember, when we were talking on the show yesterday, we were talking about the fact that gold had held that minor support, and it was ready to break below the 1660 level, which was that 1.618 expansion on the hourly basis. And we mentioned that if we broke through that, it would be a quick trip down to the the 1630 per ounce level, and that's in fact what we're looking at. But this does set up a bullish Gartley pattern on both the gold and a bullish pattern on the silver. If you're waiting for something to buy for Christmas, take a look at gold and silver. When H.M. Gartley wrote his book, Profits in the Stock Market, in 1937, I'll get back to the Gartley book. We got to take a little break here now, folks. Live every day in an attitude of gratitude, and may God bless, and we'll see you in a few moments.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risks, charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC. Happy holidays from TFNN. Our most rewarding Tiger Dollar sale is back this December at TFNN. Normally, we offer only a 10 to 20% bonus on Tiger Dollar purchases, but through December 19th only, when you purchase Tiger Dollars to spend on any of our products, you get a 25% bonus on your purchase, and up to 10% of whatever you spend will be donated to the Salvation Army in your name. You'll receive a personalized thank you letter directly from our local Clearwater Salvation Army administrator in appreciation of your donation. Tiger Dollars can be used on any of our newsletters or subscriptions, never expire, and are fully transferable. Take advantage of our most rewarding Tiger Dollar sale of the year right now. Visit TFNN.com for all the details and to make your purchase today. Happy holidays from TFNN.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, folks, we're going to switch over to the corn market because that's our largest agricultural, commodity in the United States. And we've been following this for quite some time. We've switched over now to the March contract. And if you get a chance to go into Tiger TV, you'll see that we're setting right at a 50% retracement of the move from last May, which was the start of the drought. And then we, went up and we made the big expansion high. We made a butterfly pattern up at that $8.50 a bushel level, and now we've come down a little over $1.60 a bushel, and we're sitting right at the 50% retracement. Now, ordinarily, 50% retracements are not, on the top of my list, but this particular one, we have a really nice ABCD pattern that's been forming since early October, and that has come down to exactly the 50% retracement. So we're sitting here at $6.96 a bushel. And, this is a spot where you have a very, very low risk to own corn. You can be a farmer here for, $6.96 a bushel, 5,000 bushels to the contract. So for around $40,000, you don't have to have a tractor. You don't have to have a plow. All you have to have is the money in your account. And the margin on this would probably be about $2,000, and you want to risk about 10 cents a bushel. So you'd put your stop at around $6.86. So you'd be risking $500. That would be your risk, and your first profit objective would be, well above the 730 level. So it would be 3-to-1 as a risk-reward ratio. Now, I've always believed that it's better to be buying things when they're cheaper than buying them when they're more expensive. And now you're buying corn a lot cheaper than you were last month. And had you been patient enough to wait for this pattern, this is the spot where you really don't have to risk very much. It might not work, but all the symmetry is there. You've got a beautiful ABCD pattern forming. You're right at a 50% retracement. The other thing is that you're right near the area where we broke out to the upside in the grain markets when we had the drought, when we cleared that $7 level. That took us from $7 to $8.50, a bushel very, very quickly, and now we've come back to test that high level. And many times when you come back and test those high levels, they act as major support. So you have that. In addition to that, you have the 50% retracement with the ABCD pattern that we've discussed coming in here, at the 696 level. So buying it around 696 with a stop at 686, seems like a relatively low risk trade in my opinion. The ABCD swing is just about as perfect as it can get. It measures also to the 696 level. So that is one that you look at, and whether it works or not, I don't know. This is actually a lot less risky trade than buying the silver or buying the gold, because they're coming down much more quietly. There's not any really extreme wide-ranging bars like we're having in gold and like we're having in silver, at least not yet. But with the corn, it's much more quiet, and it does give you the appearance that it's a little less risky. But you always use a stop because they're protected. They'll protect you from making some mistakes. And believe me, we make a lot of mistakes in this business, and that's how we make our money, is by the mistakes. Once you determine that you've made a mistake, the professional corrects it right away. The neophyte trader doesn't correct it right away. That's the main difference, between a professional and a novice, is the fact that the professional will correct the trade, immediately. And they also take the responsibility for the trades, because losses are like breathing. We have to have those in our business. We don't have losses, then we become what we think is infallible, and then you really are headed for a downfall. So remember, losses are something you should enjoy having, because that just brings you that much closer to your next profit. And when you're dealing in probabilities, like we do with pattern recognition, these patterns just repeat over and over again. They don't always work, but they repeat more than they fail, and they work more than they fail, and they have a positive expectation. In other words, they pay you more money when you're right than when you're wrong, and that's what the real beauty of what pattern recognition is all about. And it's quite simple. Everything we're looking at are these triangles, these ABCD triangles, basically the Pythagorean theorem from Pythagoras, and where ABCD is the major structure that we're looking at. Unfortunately, they don't work all the time, and that's why you have to use some common sense and use stops and try to protect yourself. Okay, we're going to take a little break here to pay some bills for our fearless leader, Tom O'Brien, and may God bless him and the whole TFNN family for the holidays, folks. I want to wish everybody a wonderful holiday.
Heard Tom O'Brien on the air, and you've seen him on Tiger TV, as well as being featured as a regular CNBC guest and contributor, and now you can have access to his expert trading advice each morning through his daily trading newsletter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, gives traders, investors, and money managers a thorough strategy for trading stocks, options, and indices every market day. Market Insights comes out each market day before 9:30 a.m. and provides traders with Tom's daily commentary, opinion, and specific trade recommendations on the markets. Using advanced Fibonacci methods, volume indicators, Gartley patterns, candlestick charting, gaps, and market timing, Market Insights will give you specific trade recommendations, including entry, stop, and exit prices. The summer is over and traders are back. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks. I posted into Tiger TV the gold-silver index because we have been watching this for the past several weeks, and it failed to hold the 61% retracement. And that now it begins to appear that we're going down to the 786 retracement, which is down another few dollars from that point. Now, I want to go over the gold chart one more time because I'm not, the silver is just too wild for most people to go into unless you do the SLV or something like that, or do a call on SLV. Then that does give you some protection just by using the call as your premium, and that would be a risk. But if we'll take a little advanced look here with this daily gold chart that we're looking at, because we are forming a beautiful Gartley down here at the 1630 per ounce level. The AB leg is equal to the CD leg in time and price, and so that tells us that we're also very, very close. We're down 8 days in a row, so the market is in a very strong oversold condition, which we're ready to go up anytime we get to this level, I believe. So my suggestion would be, if you're an experienced trader, you can buy the gold down in the 1630 level and risk usually around $15. But if you want to be more conservative, wait for the bottom to come in. And it might come in at 1630. Heck, it might come in at 1593. We don't know, because if it goes through the 618, there's no saying that it cannot go all the way down to the 786, or even, change the whole trend of this thing, and, gold could be in a massive bear market. But right now, we are where Gartley said you want to be watching, and we've been in a bear market in gold for quite some time, and this is really the first really true Gartley ABCD pattern that we've had since May, back in May 14th. So, and Gartley said buy all ABCD patterns in the bull market, in a new bull market. And so this is, in fact, if it is a new bull market, this would be the ideal place, to be looking to be a buyer of gold down at the 1630 area. So that's what we're watching. I don't know if it's going to work or not, but like I mentioned, if you want to keep your risk relatively small, look at a call option on GLD, something like that. That would be something that could look pretty good. And if it's wrong, that would be your value of your call would be your risk that you have, and then you would be able to use that as a point. Now remember, we have looked at the price of Newmont mining for quite some time, because it's been making what we think is going to be a triple bottom, and we are breaking below that triple bottom today, which is another bad sign. We said there was a possibility of that. We are now down below the levels that we were in May and August. This is either a massive triple bottom at this level, or this thing is really going to fail. So we were watching it at around the $44 a barrel, $44 a share, and we're at 43.09 now. So it's not down very much, and it is making a smaller three-drive pattern on the smaller time frame. And I should put that up, because that does give a pretty good idea of what we're looking at when we have a smaller time frame chart. If you'll give me 1 second here, I have to refresh this, and then we can take a look at it. And you'll see that we are making a three-drive pattern here. And it's not going to take us very long to find out if this thing is going to hold, because if the gold does not hold that level that we're looking at the 1630, we are going to be in big trouble, and not big trouble because we're not going to be in it, but it'll start going down, more and more. So we're almost at a perfect three-drive pattern right now. We're within about 20 cents in the Newmont, and but if Newmont closes below, $41, something's really seriously wrong with this stock, and because it hasn't been able to get out of its way. And so we'll see if that's going to be the case. But we need the gold to hold these levels if, in fact, it's going to, make a significant turn here and go up. But, we have both gold and silver at Gartley buy patterns right now, just coming in Thursday, the 20th of December. And, that's what it says. Whether it's going to be anything of any significance or not, we don't know, because these patterns can fail, but they certainly do have a better chance of working when all the numbers come together, like we're seeing, right now. Now, I wanted to switch over. We talked about the gold-silver index already, but we were talking about the sugar market, because some people had an interest in sugar. I hardly trade sugar, but I did want to bring it to your attention. We did have the butterfly pattern happen in sugar last week, and now we are having the retracement where the markets come down to the 61% retracement. Now, this would be an easier entry than buying down at point D, because the bottom is already in, and then you just put your stop below that point. This would be one way of handling the gold market. In other words, wait for the 1630 to be hit, and then turn, and then buy it on that first little pullback after it's rallied off of 1630. However, the way I like to trade, and the way we do it for the hedge fund, is when the numbers line up so perfectly like we have in the gold, with the time and price, everything coming into this 1630 to 1626 level, we just buy it there, and then just put our 3%, 3% of the value of the commodity as our stop, and then see what happens, because we know from probabilities that these things usually turn very, very close, and these numbers, even though they are called numbers of sacred geometry, they hold up a lot more than than random, and that's really what we're trying to do here. We'll see if it works. We're not going to be on the show on Monday because it's a holiday at TFNN, thank God, and I hope everyone has a wonderful holiday with their families and everything. And the only thing that I suggest is that we have so much of abundance in our lives that give some things to people that don't have abundance. Whether it's a street person or someone at the Salvation Army, which is a great organization. Try to help somebody out, because people that are having a really rough Christmas. Christmas is tough enough when you don't have anything, but if you've got something to give to someone at Christmas time, that's. We were talking about the sugar market. The fact that we did make a nice Gartley pattern down, butterfly pattern down at the $18 level, and then we rallied up and made a really nice move of well over $1,000, and now we're backing off a little bit. Now I wanted to show you something that I think is relatively important, because we talked about this commodity in the past, and that is the natural gas, and we have had tremendous moves in natural gas just in the last few days, and I'm going to put that into Tiger TV so you can take a look at it. This has had some tremendous swings, folks, and I'm talking here thousands of dollars, because it went from 328 per cubic foot up to 343 per cubic foot, and that's well over $3,500. And not only that, but it came down twice to that level. In other words, it went up and then came down one more time down to the 328 level, making an ABCD pattern, and now we've turned back up again. And so these are very, very volatile moves that we have going on in some of these commodities. That's typical of around this time of the year, because they have less traders in there, and natural gas is not one that a lot of people trade, and so it just takes a little bit of movement in order to see the actual market change. And what's really nice on this one is I'm going to show on Tiger TV the shorter term swings that we had here, because over a period of a week, we had moves that went up $3,000 and then down $3,000 and then up $3,000. So these are really, really monster moves, and you have to be able to take some profits on some of these things, and that's the other thing that's really important. Now, on Wednesday's show, we talked about the wheat market, because wheat was making a very, very important bottom down at the $8 per bushel level, and I'm going to bring it up on a smaller term. I better do a little bit larger term, so that folks won't get thinking that I'm a micro trader. But we had a huge ABCD move coming off of the $8 level, and it rallied all the way up to the to $1,000 a contract on the from the buy down at the 802 level, and from that point, the price of wheat absolutely just broke down. And that's why you really want to be able to have to understand how to use stops, because once you go below the 786 of a previous number, then you're going to go to the next level. That's just a very, very high probability of that occurring. So that's very, very important. Now we have one other position that we've been in for a very long time, and it's time to beginning to look to take profits, and that is in one of the currencies that we've been watching, and that is in the Japanese yen. Tom was very bullish on this way back in the $75 range. We became bullish around the 77 level, and now we're making expansions of this particular currency, this cross rate of the dollar versus the yen, up in this 84 70 level, and we're trading right now at 84.30. So anytime you get above 84.70, you certainly want to be getting out, taking profits in this. It's in a 14-day run. In other words, it's been going straight up since the 3rd of December. That's when we talked about the breakout above 82.83. That gave us the target of 84.71, and we're coming in there now. And so this is where, this does not mean that the bull market is over by any stretch of the imagination. What this means is that, we're at a major profit objective here. We've had 3 major waves here that started way back in October. The first one went from 77 to 80, then it backed off just a point, and the next one went up to 83, then it backed off a point, and the next one's gone up to 84, almost 85, and so we've gone from 77 to 85. That's $8,000, since late September, and so this is where you'd want to be, getting ready to take profits. Remember that this used to trade at 260. It's trading at 85 now. So this has a long way to go. We're going to take a little break here and come back, and we'll talk a little bit about the stock market.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and we're talking about the E-mini S&P. I think that I posted into Tiger TV shows that the fact that we made the 786 off of the September high now. Realize, the Dow and the New York Stock Exchange Index have all exceeded that. The E-mini S&P has not. It just completed the ABCD pattern up at this in the new contract for March at 1446, and just a normal correction so far. It really means nothing at all. I think that if you'd fall back on what Basil said about the VIX, I think it's very important because. If the market is going to turn down, that VIX is going to have to get above 19, and it's not even close to that right now. There's no fear in the market at all. But if the VIX starts to move above 19, signify more of a trading situation where you would have a move to the downside. But right now it's just making a normal daily correction. From the, just actually a one-day correction is all it is and hasn't really done very much. So keep an eye on the VIX. The other thing that we're watching very closely is the bond market because, we've come down and we've tested the 786, the 61% retracement level at this 146 level. And if bonds are going to have one more jab up into that higher time frame of 154, to higher, one more flight to quality, it's going to have to hold this 146. But if we break below 144 in the Treasury bond, folks, we're going to have a really severe, downtrend because that's going to break a lot of support that has been going on for a very, very long time, in the bond market. And if I can put the weekly chart up here, you'll be able to see that, we've had this tremendous run from 2011, and what we've done now is we've just come back and we've tested this 786 retracement, and as long as we don't go below the 144 level, we're still in the potential for this market, to go higher. The problem on a technical basis is beginning to look like what the corn market did. It goes up to that 850 level and then went sideways and then started down. So it's extremely important that we hold the 145 level in the Treasury bonds. We're about a point and three quarters away from that, and we're in the fourth week of a down move. But it wouldn't take very much for the market to jab up one more time up into that 155, 156 level. Giving us the final objective that we think we're having, because this is a 30-year bull market. In other words, interest rates have been going down for 30 years, and that's most probably not going to, stay forever. And so this is one of the things that we want to be able to really get on board, once it's started. But for the bonds to really turn to the downside, they must take out the 145 level. That's the equivalent of breaking below the 786 of the last low. That would be equivalent to what happened in gold when it broke 1690. It'd be equivalent to what happened to silver when it broke 3220. And so that gives you the way to look at it as far as numbers. That once it breaks through those numbers, it will most probably go down, to the next level. This has been an incredible bull market that we've had with lower interest rates, thanks to our Federal Reserve, and they made interest rates for the bank just very, very nice for everybody, but not so much. Listen, I want to wish everybody a wonderful and happy holidays, and may God bless and live every day in an attitude of gratitude.